The economic cycle is when the economy moves from growth to recession and back to growth again. It's one of the most influential forces in the stock market. The economic cycle is significant because it plays a large role in determining corporate profits, which are probably the most important factor that influences stock prices. Where things get complicated is how the economic cycle impacts different sectors. Stock market sectors are sensitive to different stages of the economic cycle. Simply put, some sectors may outperform when the economy is growing, while others may outperform when the economy is in a recession. The varying performance is something that investors refer to as sector rotation. Sector rotation is driven by investors buying and selling different stocks during the economic cycle stages of growth and recession. Let's look at an example of how sectors typically perform throughout the economic cycle. Let's suppose that the economy is emerging from a recession. One of the first sectors that investors usually move, or rotate, into is financials, which includes businesses like banks, brokers, and insurance companies. Why? Toward the tail end of a recession, interest rates are unusually favorable for businesses such as banks. Consequently, investors rotate into the financial sector when they anticipate a recovery. After the economic cycle turns up, investors usually next rotate into the technology sector. This sector is sensitive early in the economic cycle because businesses invest in new technology to make productivity gains. As the economic recovery gathers momentum, investors typically move into the consumer discretionary sector. This includes businesses like automobiles, housing, and retail, things that are discretionary or non-essential. Consumers typically grow more confident as the economic recovery takes hold. And with the growing confidence can come increased spending on discretionary items. After consumer discretionary, investors generally rotate into the industrials and basic materials sectors. This is usually considered the midpoint of the growth stage, which is when these types of businesses increase production in response to increasing demand. As the growth stage matures, investors typically rotate into the energy sector. At this point in the cycle, the energy sector benefits from increased demand for transporting goods during the previous stage of the cycle. When the economy transitions from growth to recession, investors may get defensive and start to rotate into the sectors that are less sensitive to the economic cycle. These sectors are sometimes referred to as defensive sectors because they can offer relative protection during a recession. When considering defensive sectors, think about it this way: what are the goods and services